You're the catalyst to watch for the next about week and a half, and there are some big ones, including the numbers coming out for the Consumer Price Index, which is in just a week from today. And in a week from now, we'll also start getting some of the initial earnings sets, most of the juice coming right after this upcoming week. But first, let's get into some catalysts in terms of expectations. So today we'll get some factory orders and durable good numbers. We'll also be getting the FOMC minutes. Those will be out at 2 p.m. Eastern, 11 a.m. Pacific. That'll be the big catalyst for today. We'll be looking for what does the Fed actually think in terms of this idea of a hawkish skip. Jerome Powell told us he didn't want to call it a skip, or that he shouldn't call it a skip. But what does that mean? Does it mean that you've paused, or does it mean that there are maybe many more rate hikes to come? In his recent discussion with Sarah Eisen, he suggested that forecasters were expecting potentially as many as 2 or more rate hikes coming. Of course, markets seem to be relatively calm about the idea that, okay, we might get another 25 or 50 BP from the Fed, or even a little bit more, because frankly, if we look at the past year, we had 500 basis points of change in interest rates. Going forward, we've got maybe another 50 plus or minus, so 10% of what we had over the last year. It's kind of like getting spanked really hard for a year long, and now they're kind of just like, softly touching us. It's not a big deal anymore. Of course, then you wonder, when is the lagging impact of those previous spankings really going to come through? Tomorrow, we will be looking for ADP employment numbers, which is exciting because it leads into Employment Friday. That's a big deal for this week. Employment numbers tomorrow are expected at 5:15 a.m. We will expect that private payrolls report. It's really a tool that we use to try to be critical of the actual official government data with, which is useful. We'll also get some job-changing payrolls numbers in terms of how much wages are rising. Remember, we do not want any indicators of a wage price spiral, and even though wages can still grow above 3% to be consistent with 2% inflation, we want to make sure those numbers aren't disanchoring. So we'll take a look at that tomorrow. We are expecting 223,000 jobs in the ADP report tomorrow. That is down from the 278,000 jobs in the prior release. So we'll go through that private payrolls report in detail. Initial jobless claims, which come out tomorrow as well, are expected at 245, with continuing claims at 1.75 million, both of those roughly stable. PMI numbers tomorrow at 6:45 a.m. California time, expected at 54.1, with JOLTS job openings out tomorrow as well. A lot of catalysts coming up. It's not just those darn minutes. But the JOLTS numbers expecting to finally show some decline from 10.1 million to 9.9, although frankly that's relatively low. And even at 9.9, with about 6 million in unemployed, we're still looking at about 1.65 job openings to unemployed individuals. It's shrinking. Jerome Powell was really hoping for this number to get closer to 1-to-1, but it's been a very, very slow trend to get job openings to actually close, mostly as businesses continue to either labor hoard or have enough profitability which enables them to labor hoard and hopefully spend through this recession, or whatever we're going to call it. As far as catalysts, I don't know when we're going to have the next coupon expiration. I can only imagine many of you are highly curious as to when that is going to be, but of course the courses are linked down below. Then we've got the 2-month payrolls revision. That'll come out with jobs data on Friday. So we'll be looking at revisions as well as the job numbers. So what kind of job numbers are we expecting on Friday? Well, in the last report, we had 339,000 jobs. In this upcoming report, we're looking for 225,000. So a pretty big drop in that payrolls number, although still vastly positive. I think JP Morgan has an estimate that maybe, just maybe, will actually go negative in payrolls as soon as September, But frankly, if we get a June report at 225, it seems wild that in just basically 3 months or 3 more reports, July, August, and September, will actually be negative. But who knows? Unemployment rate is expected to drop actually from 3.7 to 3.6. Looking for average hourly earnings coming in at 0.3%, which is nearly consistent with the 3.6% that you would like to see. 3% would be consistent with 2% inflation. 0.3% would be consistent with 3.6 at an annualized rate of wage gains. So that would be a little hotter than that 3% you'd be looking for to get to 2% CPI, but getting closer, which is good. We really don't want to see that number disanchor. That wouldn't be great. And average hourly earnings year over year expected to be 4.2%. Labor force participation rate expected to be stable at 62.6. Then on the 10th, going into next week, we'll have wholesale inventories and trade sales data, as well as the big one, CPI. Mark your calendar if you have not yet for CPI data release on the 12th. That'll be very important. July 12th, we will have the CPI month-over-month expectation set right now for 0.2%, which is up from the 0.1% in the prior read. However, core month-over-month is expected to be down from the prior read of 0.4 to 0.3. With listen to this, now that we are comparing year-over-year inflation to the peak level that we had last year, who here remembers? Leave a comment. Who here remembers doing CPI on the beaches of Germany? Well, it was a beach of a lake. They still have beaches. But anyway, I was doing that, streaming from the beach in a beach in Germany last June, and we got the highest report. I still remember, ever, basically, in the last 40 years. I still remember making the thumbnail because the expectations were 8.7%. And so I made the thumbnail with a big 9% in it. And then we ended up getting like a 9.1%. It was insane. But anyway, why that's so important is we are actually a year away from that now, which means we are going to lap that number, which makes our year-over-year comparison pretty good. In fact, listen to this. Instead of a 4% like we had in the prior read, we are expecting headline CPI to be just 3.1%. That's insane, especially because if we miss that by just 0.2%, we'll be at 2.9%. And remember, inflation expectations are trending down. We're at the lowest level in 2 years in inflation expectations for the 3 years out, as we talked about yesterday. And why does that matter? Because they can often be self-fulfilling. If people expect low inflation, what happens? They don't tend to go out and buy, and it tends to self-fulfill lower price increases and a more moderated economy. So that CPI report is going to be delicious next week, and it will be what ends up as the deciding factor for the June 22nd FOMC meeting from the Fed, which happens 2 weeks after our next CPI data. So we've still got a little bit of a wait here for the Fed. 3 weeks from today, basically, for the Fed. 1 week from today for CPI data. On the 13th, we'll get PPI data. Then we'll start looking at some import prices and University of Michigan consumer sentiment surveys again. But probably what's going to be more entertaining is the fact that starting the week of the 14th, on Friday the 14th, we are actually starting to get bank reports in the morning. We'll be looking at JP Morgan, United Health, Citigroup, Wells Fargo, all of them reporting in the AM of Friday the 14th. And that is going to set off the ringing bell for earnings season. By the way, shout out to Gasman and 31095 for remembering that June report. And thank you, by the way, for mentioning entertaining house hack video, Kevin. I'm not so sure about the ... ellipse you've got there, but I'll take it. Thank you. Anyway, as far as earnings, we got a lot of them coming out. Specifically on the 18th of Tuesday, you're going to be looking at Bank of America, Schwab, Morgan Stanley, PNC, Bank of New York Mellon in the AM. Then in the afternoon on the 18th, this is close, folks. This is less than 2 weeks away. Interactive Brokers, JB Hunt. On that Wednesday, the 19th in the morning, you'll have Goldman Sachs, Halliburton, US Bancorp, NASDAQ, Ally Financial, First Horizon. So a lot of banking stress will be looked at. Then, of course, you'll get the juicy stuff. You ready for this? Netflix, United Airlines, IBM, Steel Dynamics. Isn't Tesla? I'm pretty sure Roblox. Pretty sure Tesla is on the 19th. No, sorry, Roblox isn't there. Pretty sure Tesla is on the 19th as well, but I'm going to confirm that because I don't see it on this list. Anyway, AM on the 20th, you get Johnson & Johnson, Taiwan Semiconductors, D.R. Horton. We really want to see what those home builders are up to. Let me quickly get it here. Tesla earnings release, which I suppose a note is in store for the home builders. The home builders have killed it. I mean, prices, even as prices were falling mid to late last year, even as prices were falling for real estate, the builder stocks were doing well. And then, of course, this year so far, prices have been falling, have been rising. So real estate has not been a short this year, given that prices have been rising. And potentially the catch-up play there, in my opinion, confirming July 19th for the earnings announcement after hours. But anyway, for Tesla. But as far as the home builders, possibly the way to play catch-up on the home builders, if real estate does well, if it does, solar. We'll see, but that's the left behind stepchild of the stock market rally over here. So we'll pay attention to the solar industry as well. Obviously, earnings this upcoming earnings season could be a catalyst as well, given the lack of sort of wholesale ordering that really crushed some of those Q1 numbers coming out of Q4, which is usually where you have a big solar push. So those are some of the big catalysts coming up. Obviously, regarding Tesla, not only are people going to be looking at vehicular margin, which might actually go negative for a certain, the standard model of the Model 3 in China, which is wild, which means if we get less orders in China, that could be good. Given that China has relatively started slowing down, maybe we have more US and European sales for that Model 3, which could boost margin, which would be good. Obviously, the next red flags for Tesla are going to be negative free cash flow and potential money raise. But after those delivery numbers over the weekend, there's a lot of optimism for Tesla. Tesla did end up closing up 6.9% on Monday, which is quite remarkable. And if you want to be aware of these sort of quite remarkable posts, then it's really important that you follow me on Twitter at RealMeatKevin. See, I wrote, Tesla literally closes up 6.9%. You can't make this stuff up. And there's a screenshot of it. And then sure enough, within 2 minutes of me posting that, out of nowhere comes Elon Musk liking the tweet. So, anywho, that's where you've got your calendar shaping up. I would say by far the biggest catalyst out of all of this is going to be the CPI read, obviously. The CPI read's a big deal. It's going to dictate exactly what ends up happening with the Fed. Are we going to get another hike or not? If we get a miss here, I'm very excited. I would love to see a miss. I am nervous that there's a chance we could end up getting a beat, as in like a higher number, although sometimes people call like a lower number a beat. But anyway, there is a risk of a higher core thanks to travel, specifically that air travel, the hotels, the lodging. People have just been spending, I think, more than the seasonal adjustment is going to consider. So there is that risk. But you know what? It ain't fun if there's no risk. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by